Hello viewer, and welcome to this definitive guide on International Accounting Standards 16, or IAS 16, covering property, plant, and equipment. I am your presenter, Suresh Periyasamy. I am a CPA and member of CPA Ontario in Canada, a licensed US CPA and member of the AICPA, and a fellow of the Institute of Chartered Accountants of Sri Lanka. Whether you are a student preparing for exams or a professional navigating complex asset transactions, this session will take you through the entire life cycle of tangible assets under IFRS, from the moment they are recognized to the day they are derecognized.
Let's start with the strategic context. For many companies, think airlines, manufacturers, or utilities, property, plant, and equipment is the single largest number on the balance sheet. These aren't just accounting entries. These are the physical engines driving the business's revenue. The primary objective of IAS 16 is transparency. We need to answer three fundamental questions for our investors. Recognition. When does a spending decision stop being an expense and become an asset? Measurement. What dollar value do we assign to it? Depreciation. How do we allocate that cost over time to match the revenue it generates? Without this standard, companies could manipulate profits by arbitrarily expensing or capitalizing huge sums. IAS 16 brings discipline to this process.
IAS 16 is the default standard for physical assets, but it has strict boundaries. To fall under IAS 16, an asset must be tangible, held for use, and expected to last more than one reporting period. You must be careful not to confuse PPE with assets covered by other standards. If you intend to sell the asset soon, it moves to IFRS 5 as held for sale, and depreciation stops. Living plants and animals usually fall under IAS 41, with the specific exception of bearer plants, like grapevines, which stay in IAS 16. Mining exploration rights have their own unique standard, IFRS 6. And if you own a building just to earn rent or capital appreciation, that is investment property under IAS 40, not PPE. So when do we put an asset on the books? We apply a strict two-pronged test. You capitalize an item if, and only if, it is probable future economic benefits will flow to the entity, and the cost can be measured reliably. A common practical question arises with spare parts. Small consumables like bolts or oil filters are inventory, but major spare parts, like a backup generator or a replacement aircraft engine, are recognized as PPE if you expect to use them for more than 1 year. This matches the expense to the period of protection or usage they provide. Once we decide to recognize an asset, we measure it at cost. This includes the purchase price, import duties, and any directly attributable costs to get the asset ready for use, like site preparation, installation, and testing. It also includes the present value of any future dismantling or restoration obligations. I want to highlight a critical update effective from 2022 regarding proceeds before intended use. In the past, if you built a factory and sold sample products during the testing phase, you netted that revenue against the cost of the factory. This is no longer allowed. Now you must recognize both the revenue and the cost of those samples in profit or loss. This ensures the balance sheet reflects the true gross cost of the asset, and the income statement reflects all operational activity. After day 1, the entity must choose an accounting policy for each entire class of assets. You cannot cherry-pick specific assets. Your choices are the cost model, which is the most common. It's simple. Cost minus accumulated depreciation and impairment. It prioritizes reliability. The revaluation model. This keeps the asset at fair value. If you choose this, you must revalue frequently enough that the book value doesn't drift far from market value. If you revalue one building, you must revalue all your buildings to prevent manipulation. If you choose the revaluation model, the accounting depends on whether value goes up or down. A gain generally goes to other comprehensive income, or OCI, and sits in equity under revaluation surplus. We don't put this in P&L because it's an unrealized gain. A loss generally goes straight to profit or loss. However, there is a memory rule. If you have a loss on an asset that previously had a gain, you first wipe out the existing surplus in OCI before hitting the P&L. Also, note that you can transfer the, quote, excess depreciation caused by the revaluation from the surplus directly to retained earnings to keep your distributable reserves accurate. Depreciation is often misunderstood. It is not a method of valuation. It is a method of allocation. We are spreading the cost over the asset's useful life. IAS 16 requires componentization. If you buy an aircraft, the engines might last 5 years while the body lasts 20. You must depreciate them separately. If you don't, your expenses will be wrong, and you'll face a massive write-off when you replace the engines. For methods, you can use straight line, diminishing balance, or units of production. However, Revenue-based depreciation is strictly prohibited. While depreciation handles the expected consumption of an asset, impairment handles the unexpected loss of value. Under IAS 36, if indicators of impairment exist, like a market crash or physical damage, you must test the asset. If the carrying amount exceeds the recoverable amount, you must write the asset down. Regarding subsequent costs, day-to-day repairs are expensed immediately. Major overhauls, like a 5-year inspection, are capitalized. Crucially, when you capitalize a new overhaul, you must derecognize any remaining carrying amount of the previous overhaul. Finally, an asset leaves the books upon disposal or when it's scrapped. We calculate the gain or loss by comparing the net disposal proceeds against the carrying amount. 2 key points here. Presentation: gains are reported as other income, not revenue. We don't want to confuse operating sales with asset sales. Revaluation surplus. If you sell a revalued asset, any remaining surplus in equity is transferred directly to retained earnings. It is not recycled through profit or loss. IAS 16 is heavy on disclosure because users need to understand the movements in the asset base. Most importantly, you must provide a reconciliation, a movement table showing the opening balance, additions, disposals, depreciation, and closing balance. Let's apply this. Imagine Global Steel builds a furnace. First, they sell test samples for $20,000. Under the new rules, they record $20,000 revenue and $20,000 cost of goods sold. They do not reduce the asset cost. Second, they split the asset. The shell is depreciated over 20 years, the lining over 5. Finally, in year 5, when they replace the lining, they derecognize the old lining and capitalize the new one. This keeps the asset register accurate. In our second case, ChemCorp spends $2 million on safety scrubbers. These don't generate sales. Can we capitalize them? Yes, because without them, the law says the plant can't operate. They are necessary for the rest of the assets to generate revenue. To summarize, IAS 16 is about more than just bookkeeping. It is about economic storytelling. It is rigorous in its recognition criteria. It is transparent in how it handles proceeds and disclosures. And it is dynamic in how it handles complex components and revaluations. Mastering this standard ensures your financial statements truly reflect the operational capacity of the business. Thank you for watching this guide on IAS 16. If you have questions or need personalized help with your accounting or auditing studies, I offer one-on-one tutoring. I am Suresh Periyasamy, and you can reach me via the SuperProf link displayed on the screen. I look forward to helping you master these concepts.